Welcome back to another episode of Policy and Profits. I'm EJ Antoni. I play an economist on TV. I am joined by the one, the only, Anthony Esposito, who heads up the fabulous Island Capital Investments. He is not only one of the greatest traders Wall Street has ever known, he's even a reluctant civil rights icon. Anthony, how are you doing this week?
I appreciate that, and I'm doing very well, thank you. Winning at life, as I try and say each day. How are you doing? That's that. First of all, thank you for that intro, and how are you?
I am hanging, and it's been a increasingly positive week in terms of all the economic indicators. That's not to say everything's all sunshine and rainbows, but it's really interesting when we see things like the manufacturing index out of the Philadelphia Fed, for example. Even though current conditions still show the sector contracting, the expectations part of the index, what people think conditions are going to be like 6 months from now, that is taking off like a rocket ship post-election. And so we're definitely seeing that Trump bump.
So let's go into along those lines, and we are seeing a Trump bump. I'm seeing it everywhere, whether I'm getting a bacon, egg, and cheese in the morning, or I'm getting gas, or I'm just talking to other traders on the desk. Everyone is more confident, everyone's feeling better, and everyone feels like there was a huge weight lifted off their shoulders with the Trump win. Don't care if you're red, blue, or in the middle. This is definitely a positive. Consumer confidence. We have that chart up. You were talking about it earlier in the week. This is the October number. So we got a bump up in consumer confidence, came in at 108 versus 99. Now, granted, these numbers are kind of mid-range for the last, if we go back, 2 to 3 years, we're mid-range, but definitely a bump up in October. Do you feel like that was part of the Trump bump with this consumer confidence number? And do you think it can continue?
I think so, and the reason for that is because if you actually compare these indexes, how people feel about not just the economy today but future conditions, and then you overlay that with the polling data, and more specifically the betting markets, what you see is that the more times Trump was ahead and the further he was ahead, the better people actually felt the economy was going to be in the future. And so it seems really clear to me that people are connecting a Trump presidency with better times ahead. And really, this is kind of just a replay of what we saw back in 2016 and even into the beginning of 2017, where when Trump won the first time around, we saw that people's expectations dramatically increased. And really, Anthony, I think we're just seeing a replay of that.
Yeah, this is almost like that 2016 move on steroids. Because remember, and I was actually trading at Hartz Capital at the time, for the Stern family, and we were overnight trading. The futures actually got crushed, which I don't know if people remember this or not, but the S&P futures were down an egregious amount. I don't remember if it was 3% or 5% overnight. And then we got the bounce, the realization of what happened, and then we got the Trump rally. But this was different. This, we saw a rally actually coming off of October 31st. There was a lightening up, which I had actually written about in the newsletter before the election. I expected kind of a lightening up of a known unknown. We knew the election was coming. We didn't know what the results would be. There was some delevering, some lightening up and hedging. And then heading through the 5th and the 6th, I mean, we just exploded. There was nothing further to the downside at all. Now we've kind of topped out a little bit with the market. We're a little tired and we're finding our way. But this is definitely the Trump bump on steroids right now, and kind of consolidating at the upper end of that 6%, 5% rally. If we look at consumer confidence and we roll to credit, because this is the problem, right? We have a more confident consumer now. Sentiment is still good, or is improving to some degree, or will improve further as we move through the January with Trump taking office. But we have consumer credit at all-time highs. So what's the reality of where we are credit-wise, where the consumer is in reality versus what their expectations of this better tomorrow is? Because that's really what this comes down to. And how long, as we've spoken about, how long will it take to fix what's broken? Because we're on the right path now. We will be on the right path with President Trump taking office. But there's going to be some pain, right? We need to fix the problem. So as far as consumer credit card limit increases was the topic that you had thrown out earlier in the week. I thought it was a great angle. Where is the consumer as far as credit, and can the consumer actually act upon that good feeling?
Great questions. Increasingly, Anthony, what we're seeing in the data is this, the stark dichotomy where people with very high incomes and very high net wealth are still doing okay, maybe not great, but they're getting by just fine. And it seems to be the rest of America that's falling deeply into debt. And we've talked about this a lot in the past, and this really, I think, played into the results that we got on election day, where so much of America was so fed up with falling so deeply into debt, falling so behind, their standard of living going down as the cost of living goes up. And increasingly, though, what we're starting to see is as that credit seeking behavior on the part of the consumer continues, they're increasingly getting turned down for things like credit limit increases and additional lines of credit. So even though people are still trying to get new credit cards just as much as they were before, the banks are increasingly telling them no. And there's a couple of different reasons for that. You can say on the one hand, it's because banks either don't have the money to lend or they're choosing alternative borrowers, whether that's mortgages or some other line of credit. But it also could just simply be the fact that people are no longer in good shape financially when we run their credit scores, for example. The banks might increasingly be saying, you know what, you're not a good credit risk. So even if I have the money to lend, I don't want to lend it to you. And as that basket of people with you might call it subprime credit continues to grow, you're seeing the rejection rate continue to grow, or in this case, the number of people who, even if they're not asking for additional lines of credit, they're just asking for more credit on existing lines, they're being told no.
Yeah. It's interesting because on an individual level, and obviously, part of the problem, which we've talked about and everyone knows, is people are using credit to buy groceries now. People are using credit to buy gas now. People are using credit. President Trump taking office is a phenomenal turn in this story. However, the pain is real. So people now are going to start to get squeezed. And if they can't get the credit that they need and they can't pay their bills, it's going to start to become, well, not that I didn't get that extra pair of shoes, or I didn't get that new watch I wanted. It's going to be, I wasn't able to buy enough groceries for the home. I wasn't able to get gas for the car. Like, these are the issues that we're facing.
Right.
And
right.
in addition, we're seeing rates go up. So as that consumer credit number continues to climb, not only on actual debt being used, but then the interest rate that's laying on top is building that number, right? As far
Bingo,
as the
right.
principal amount. And we're seeing the same thing with the government. So we've talked about this where, Mr. Powell, with his cuts in interest rates, is actually leading rates higher as the bond market is realizing they want more of a return to lend money to the government. Those rates are going higher. So you have credit card rates going higher for the individual, mortgage rates going higher for the individual, even though the Fed is cutting rates, and you have the yields going higher, where the government needs to actually pay more money to actually borrow money from investors. So it's not a great situation as far as the reality of rates and the debt burden. It is a better situation in people's confidence and feeling of tomorrow will be better. We just have to get there and get through it. And I think that that's true. First thing I'd like to see happen after President Trump takes office is remove Powell and Yellen and get someone in there, get two people in there that have the right idea and are moving the country and policy in the right direction. But we've already gone through that before. I actually want to go on Polymarket. I thought about this today, actually, as I was opening up trading here. I want to go on Polymarket and I want to see it. I'm going to report next podcast if I can place a bet on how long Powell will actually be in that seat.
You need to start that market, Anthony.
I want to start it, and I want to buy. I'm going to buy as much as I can. I'm a huge buyer of the Powell is out calls for June 25. I want the June 25 Powell's gone calls. I'll take as many as you want to sell me.
and there's been a lot of speculation, right, that he might be out before then. And I can't tell you how many times I've seen the picture of him and then the GIF from, I think it's Wolf of Wall Street, where the guy's going, "I'm not leaving," right? And it's like, look, buddy, you can
Oh
be
man.
removed. I mean,
Yeah.
it's very clear in the Fed's charter, at least as it currently stands, you can remove a Fed chief for cause. And he has been so grossly incompetent in his job. I'm sorry, but I think there is cause to remove him. He told us there was no inflation. Then he told us inflation was transitory. Then he told us inflation is somehow good for the economy. This is the guy who kept interest rates below 1% while inflation hit a 40-year high and only then raised interest rates. Oh, and by the way, he did so by giving us 4 of those 75 basis point hikes right after he told us that the 75 basis point hike was off the table, probably because he was still trying to get confirmed by the Senate to stay in his job. I mean, and then he gave us obviously not only the disastrous inflation, but the disastrous interest rate hikes. So he has completely botched the job. I think that's more than enough grounds to remove him. But the other really interesting thing, Anthony, is if there's a vacancy somewhere else on the board, Trump can actually nominate Powell to fill that vacancy. And so then Powell has to decide, do I want to accept that nomination or not? In which case, he's gone anyway. So Trump can actually force him into a demotion, even if he can't remove him from the board entirely.
That's interesting. Well, as my father would say, we could do this the easy way. We could do this the hard way. It's up to you. Either way is getting
the
done.
Italian way.
Gabagool. All right. So, Target reported big miss as far as their numbers, a miss as far as their outlook. These are the things we get, and I do believe we are late in the cycle, and we are extended as a market. But these are the things, right? What are the Wall Street analysts saying the estimates are? Did you beat? And then are you able on a forward basis to support your stock price and appreciation in your stock price? What is the return on these stocks? So we've already seen broader stroke. Goldman Sachs come out and talk about a 3% annualized return for the next decade versus the 10% annualized return we've seen for the past decade. Not good for stocks. Okay. Target comes out. Target's a good bellwether. And you and I spoke about this earlier in the week. It's kind of in the middle, right? They have, it's not Walmart, but it's not Lulu. They have all the goods you want. They have a grocery section in a lot of the stores. They have apparel, they have shoes, they have home goods. So Target as a bellwether is down about 33% in the past year from its peak and took a 20 or so percent hit, 23% hit off the earnings report. That's a legitimate move down in a name that is supported by the consumer, and the consumer is 70-ish% of what drives this US economy. So in looking at a chart like this, we can kind of connect all the dots with what we're talking about here as far as a consumer that's happy to look forward and more optimistic, but still struggling or has clearly struggling past year or so and heading into the next quarter.
Mm-hmm. Yeah, absolutely. And since you brought up Walmart, I think let's contrast Target and Walmart for a second here. Walmart is not seeing a reduction in traffic, a reduction in spending, but they're seeing an increase. In fact, in their latest earnings call, I believe it was, they even mentioned the fact that they are seeing that increase in traffic from high income households. So households with more than 6-figure incomes. I mean, that's pretty astonishing that you're seeing so many, I should say, so much of the middle class, upper middle class now shopping at Walmart because they can't afford alternatives. Again, it speaks to what we were talking about earlier, how desperate the consumer is. And you know what, maybe when you've maxed out your credit card at Target and you can't get a limit increase, that now you're going to have to go shopping at Walmart because you're literally trying to pinch pennies everywhere you possibly can. So is it possible to turn all this around? Absolutely. But are we in a really tough spot? A lot tougher than a lot of people realize, a lot tougher than the macroeconomic indicators point to? Yeah, I think that's true too. It's going to take a lot of real wage growth and hopefully some downward pressure in interest rates to get us out of this. I think Trump's the man for the job, but that we still got our work cut out for us.
Yeah, there's no doubt. There's no doubt. The stories these retail stories are so familiar to me and reminiscent of the 2008, 2009 stories.
Mm-hmm.
It's the
Mm-hmm.
same trade down, right? It's the consumer trading down from high end to the dollar stores, the Dollar Gens of the world, and it's then those Kohl's and Target shoppers trading down to and other trading down to Walmart. So we're definitely in a pinch, and I think that people feel it day to day, and again are tired of hearing it that what they feel is not what's actually happening. Now I feel like there's like the curtain's been pulled back. There's a coming to Jesus moment now where we say, okay, we know how bad it is. We've all acknowledged it. We're going to move forward in the right way, but for now, we're in pain. And I think that that's been shown. So just for a second, I want to switch over um, and let's just look at the markets as we kind of head into, and I'll do some more analysis as we head into the end of the year. But we're heading into Thanksgiving week. Volumes will probably start to dry up. And seasonally, we're in a bullish period, right? The Santa Claus rally is always the biggest. Although I will note, I believe that in 2016, which was Trump's last win, that 2016 December was actually a particularly bad December. But seasonally, there's a bullish bias to the market here.
Mm-hmm.
If we take a look at this chart, I just want to compare here, and I want to go into breadth of the market a little bit year to date, which is important at this point. Everyone's been talking about the tech trade, the FANG trade, and whether all these names are kind of, whether the ship is being carried by just a few names or if there's market breadth, broad market breadth, and we're moving higher. So the answer to the question is yes. The AI trade and the tech names have really moved the market this year. They're way overweight in the S&P and in the methodology of the S&P. If we look at the New York FANG index, that's up 40% year to date versus the S&P, which is up 23% year to date. We have the NASDAQ up 21% year to date, and that spread actually has closed significantly in the past few months. But what I put up here as well is the Russell 2000 and the RSP. The RSP is actually the S&P equal weight. So when you equal weight the S&P, you actually almost create a mid cap index, right? Because you're not market cap weighting those S&P 500 names. You're actually equal weighting those names. So then the lower end of the S&P 500 kind of gains the same weight as the upper end of the S&P 500 based on market cap. If you look at the Russell 2000 up 14% and the equal weight up 14%, realize that a lot of those gains and that catch up has been very recent in the year. So for a large portion of the year, the Russell 2000 was actually at about 0 or plus or minus 1%, even as the FANGs, the Qs, the S&Ps were up, 25, 15, 13%. So as we move into the end of the year, we're definitely seeing a broader market breadth. And I do believe this is part of the Trump bump. I do believe people are trying to find places to rebalance their portfolios and put more money to work. So those FANG names are still keeping up and they're still moving. But you get to a spot where you need to take some of that out and move into new names. And then you get to a spot where there's new money being put to work in the small cap funds, in the small cap names. The interest rate story became interesting as rates come down. That's very positive for small caps as far as cost of capital and the business model. We've seen more market breadth moving forward. I do expect some kind of churn and chop here heading into the end of the year.
Mm-hmm.
I do expect December to be flat to up. I do expect first quarter of next year to be relatively difficult. But as we move into the end of the year, just wanted to point this out. This massive outperformance by FANG and by the Qs is kind of coming to pass. This broader market breadth move has been impressive and it's been great. But if you were to talk about the Trump bump and the Trump trade, there are a lot of different facets to the Trump trade. If you talk about cryptos and you talk about, the finance companies, the banks, that's all real. But I think broader stroke, the Trump trade has reignited an appetite for risk and reignited the spectrum in which people will invest in equities markets. And you can see that here on the move up late in the year, second half of the year as we headed into the election. So we'll see. We'll track those spreads and that outperformance and underperformance as we move through. And then we'll move into, as we get closer towards the end of the year, I want to do a little bit of work on the expectations for the first quarter, where we see volatility trading, what the options market is looking like and calling for, and we'll go from there. But I thought to start market breadth and how we've kind of caught up in this Trump bump in all names, it was kind of interesting to look at.
Yeah, Anthony, how much of that do you think comes from the fact that we seem to be facing a huge, I should say, huge deregulation agenda? Exactly what we saw, the first go around in the first Trump administration, where for every new rule that was proposed, they repealed multiple rules, and so you actually saw a reduction in regulatory costs for the first time, I think, since Reagan. Whereas in every other administration, it's been an increase in regulatory costs. I mean, just to give people a perspective of how bad it's been, during the Biden admin, we've added about $10,000 per family in annual regulatory costs. I mean, that's insane, but that's where we are. Conversely, under the first Trump admin, we reduced regulatory costs by about $2,500 annually. So, all that to say, regulation principally hurts those small and mid caps, because the large firms are better able to cope with it on a per sale or per dollar basis, since their balance sheets are just so much larger, right? They can spread those regulatory costs over a lot more dollars, and so on a percentage basis, it's less. So do you think that's kind of at the heart of this play here, where the small and the mid caps are starting to, maybe not catch up, but they're certainly increasing faster than they were the rest of the year?
Absolutely. The bottom line is half of the Russell 2000 is not profitable, right? So we'll put that to the side, just pin that and leave that. The bottom line is this rally and this bump, you are spot on. It's about deregulation and it's about rates. If the small, in a disproportionate fashion, rates and regulation affect the small caps and the mid caps much more than they do the large caps, for multiple reasons. Their access to capital and their ability to move through that regulation as a percentage of their sales and their growth, it just doesn't affect the large caps the same way. So as we look at the prospect of deregulation under Trump and we look at the prospect of lower rates, that definitely has been a big bump for small cap and mid caps. The question really is, are rates going to stay low? Is their cost of capital going to be reduced? And regulation, I'm sure, is going to be cut from past performance. Past performance is an indication of future performance in this case with President Trump. That's been the bump. And then the question is, the broader question is, so that we have lower regulation helping the small caps, mid caps. We have hopefully lower rates at some point in the cycle helping small caps, mid caps. The question becomes, has enough damage been done during the Biden-Harris administration where the economy is just struggling to a point where these small caps, mid caps actually fall deeper into the red versus turning profits and actually growing their companies? That's going to be the big question. So they will lead out of this because they're going to actually benefit more on a percentage basis than the large caps with this deregulation. However, if we do see a knock on the economy and we do see a slowdown, those small caps, mid caps, they will lead the way down, meaning they will underperform the large caps. They will get crushed. So that's something to watch. And that's a very good point, EJ. I agree 100%.
Gotcha. So, with all that in mind, are we kind of in a wait and see? Is it too early for people to think about, maybe some rebalancing, let's say, in those portfolios, kind of take some profits off of the FANGs maybe?
Yeah, I think the rebalance has occurred. There's no question, as we had NVIDIA's numbers last night, and I'm not sure where NVIDIA is today, but it was taking a little bit of a dip today intraday, but still near the highs. There's a rebalance that happens across the board on Wall Street, whether if it's individuals or institutional investors, where they need to rebalance. They do their monthly, their quarterly, and that money's coming out. The thing is, money's continue to come in, right? As this momentum they're momentum names, so they're going to continue to be invested in. I think the rebalance into small cap, mid caps has occurred. I mean, again, in the past 6 months, they've caught up from 0 to up 14% year to date. So that's been a good either rebalance out and into those names, or new money that was not willing to invest in those names, invest in those names. So we're starting to see that in, as far as profit taking and rolling out of these names. I tend to think we're later in the cycle. I tend to trade here at Island Capital. We have more of a short to intermediate term view. So I have some core holdings that we believe in and we're long, but I do trade around volatility. I trade around gold and crude. and I trade around my sectors of focus in a different way with a different timeline, time horizon. If I see something willing to move on momentum for the next, 6 to 12 to 18 months, I'm all in. It's not a problem. But I am a little more active, and that's part of the niche that I fill here at Island Capital. So for me, the average investor holding stock, I think we're getting to the point where on a year-end rally, I would lighten up on some stock, especially coming out of the election, and then be willing to ride them higher and just hold. I want to be positioned as an individual here with some dry powder as we really have extended through a decade of massive growth. I mean, 10% annualized returns for 10 years with the underlying issues you and I talk about every week. I would like to take some off the table and just be prepared for a move down or still be able to participate on the move up. And I continue to say, as an individual, a 4.5% yield or 4.25% yield on riskless fixed income, U.S. Treasuries, I don't think it's a bad thing for an individual in looking to invest in stocks and create a portfolio and gain a return. So lightening up year end, not a problem at all for me, even if it was 10 to 15% of the portfolio. If we start to see a break in these names, we start to see a break in the economic numbers and a break in momentum and a real longer term on a monthly or a quarterly basis, which I do track as well, a breakdown in the indices. That's where people need to be able to say, I want to be out for now. I'm going 50% cash, like Buffett, as we talked about last week.
Mm-hmm. Right,
I'm going to really increase my cash reserve, and I'm going to be willing to buy when it looks really, really ugly. I'm going to be willing to step in and buy 5%. And when it looks really ugly again, I'm going to buy another 5% and kind of pick away through that process. But for now, it's been a great run. I do think we're late cycle. I do think lightening up at this point, heading into year end, is a smart thing.
Gotcha. And as always, I'm sure, despite the recent pullback, we're still long gold, right? Right. No reason to panic yet.
I will tell you what, and I say this with a big smile, that pullback was very profitable here. We caught a very nice short signal in the front month gold contracts, which we executed on and realized the trade, and then bought those gold contracts back as they headed up through 2,600. So I like gold going to 3,000. I like the movement in gold. The recent move down in gold was a gift, in my opinion, as far as tradable, and to come out of the trade net long is the way to be, the way we are. And I think we still have upside. So yes, I do like gold. I love the move. It was an opportunity to make some money on a trade, and now we're back to making money on a position.
Terrific. Now on gold, just real quick, personal question here. How much should I be investing in gold in terms of, let's say, jewelry gifts for the wife and the girlfriend? So here's my thinking. Just bear with me for a second here, right? If things don't work out, right? Mm-hmm. If things don't work out, then you still have a nice portfolio, right?
That's true. So you're talking about how much gold. You see what I'm doing? You're talking about how much gold should you invest in for jewelry for gifts for Christmas?
Right. Exactly.
All right. So on a scale of 1 to 10, whatever the percentage of likelihood that you're going to be with her for another year is, I would apply that percentage to the dollar amount of your max gift. So if it's 10% that you'll be with her for the next year and your max gift is $1,000, she's getting a C note. She's getting $100 this year in gold.
Let me just write this down real quick.
Listen, I could create a little spreadsheet for you and send it over. EJ, take it easy, my man. Thank you so much. Great episode, great insight, and enjoy the weekend. I will talk to you next week.
Great to be with you as always, Anthony. Till then.